Registered silver at the COMEX just slipped into territory it has never stayed in for long. The number is so small, it's effectively meaningless for a global market that consumes more than 1 billion ounces a year. Not low, not tight, functionally zero. And almost nobody is talking about it. And while price barely moves and headlines stay calm, the foundation underneath the paper silver market is quietly disappearing. When this happens, it never resolves, it just drags on. It snaps. And by the time the move shows up on the chart, it's already too late to react. The leaked data show COMEX registered silver hovering near the dead zone, a level where deliverable inventory covers only a few days of real-world demand. This is not total silver. This is not eligible silver. This is the metal that is actually available to settle contracts if someone demands delivery. Historically, when registered inventory falls below roughly 20 million ounces, stress fractures appear. Right now, it's a fraction of that. In a market that trades hundreds of millions of paper ounces every single day, the mismatch is becoming impossible to ignore. Most investors don't understand what registered silver really means, and that misunderstanding is why this situation can exist at all. COMEX reports two categories, eligible and registered. Eligible silver meets exchange standards but belongs to someone who has not made it available for delivery. Registered silver is the only metal that can actually be used to settle futures contracts. When registered inventory drains, it doesn't mean silver disappears from the world. It means the paper market is losing its anchor to physical reality, and that is where things get dangerous. Over the past several reporting cycles, registered silver has been bleeding ounces consistently, not in one dramatic event, not in a panic, quiet withdrawals, steady conversions from registered back to eligible. Metal is leaving the vaults entirely. This is the worst kind of signal for a paper market because it shows intent. Someone is choosing to remove optionality. Someone is saying, this metal is not for sale at these prices. That message matters far more than any daily price fluctuation. At the same time, registered inventory is collapsing. Open interest on COMEX silver remains massive. Hundreds of millions of ounces are promised on paper for every ounce that can realistically be delivered. This leverage is not new, but the buffer that made it safe is gone. In past cycles, low inventory was temporary. It rebounded quickly as metal flowed back in. This time, the rebound isn't happening. The system is trying to operate on fumes. The reason the rice hasn't reacted yet is precisely why this setup is so dangerous. Futures markets don't respond to shortages until someone forces the issue. As long as contracts are rolled, cash settled, or offset, the illusion holds. But the moment even a small percentage of longs decide they want metal instead of dollars, the math breaks. And the smaller the registered inventory gets, the fewer actors it takes to trigger that moment. ETF flows are telling the same story from a different angle. Major silver ETFs have seen persistent outflows over the past year, but the metal isn't flooding back onto the market. In many cases, redeemed silver is being shipped east or absorbed into industrial supply chains. What looks like weakness on the surface is actually a redistribution. Western paper vehicles are losing metal. Physical users are gaining it. That transfer never shows up cleanly in price until it does. Industrial demand is not slowing. Solar manufacturing alone consumes a massive and growing share of the annual silver supply. Each incremental increase in solar capacity locks up metal for decades. Unlike jewelry or investment bars, industrial silver does not come back to the market easily. It is chemically bonded, dispersed, and economically unrecoverable at current prices. Every ounce consumed this way tightens the system permanently. Meanwhile, the arbitrage signals between regions are flashing red. Physical premiums in Asia, particularly in China, have remained elevated even when COMEX prices soften. That divergence tells you everything you need to know. When futures prices fall, but physical premiums rise, it means paper selling is overwhelming price discovery while real metal remains scarce. Arbitrage desks see this immediately. They buy where paper is cheap and sell where physical is dear. But that process requires inventory. And inventory is exactly what's vanishing. The COMEX was never designed to support global physical demand. It was designed as a hedging venue, a pricing reference. It works only as long as physical metal can move in and out freely to balance paper claims. When that flow stops, the exchange becomes a closed loop of contracts referencing metal that doesn't want to be there. That's the dead zone. And once entered, it has historically preceded violent repricing events. This isn't the first time registered silver has collapsed, but the context is completely different. In prior episodes, above-ground inventories were ample, interest rates were lower, and industrial demand growth was slower. Today, inventories across the entire supply chain are thin. Mines are not ramping production. Grades are declining. CapEx has been constrained for years. There's no surge capacity waiting in the wings. And what makes this even more unstable is who is pulling the metal. This is not retail panic buying. This is not coin shops running out of eagles. This is wholesale metal moving out of exchange vaults and 1,000-ounce bars. That is the language of institutions, refiners, and sovereign-linked buyers. They don't chase headlines. They move before them. From the perspective of someone monitoring this market closely, the warning signs are stacking up in a very specific order. First, registered inventory drains quietly. Then, the eligible inventory stops converting back. Then, spreads between near-month and forward contracts begin to behave strangely. Lease rates tighten, delivery times lengthen. None of this shows up on CNBC. It shows up in the plumbing. The most important detail is that none of these signals requires silver prices to rise first. In fact, suppressed prices often accelerate physical withdrawals because they discourage selling and encourage accumulation. The lower price goes, while physical remains tight, the faster metal disappears from the system. That's how paper markets break. Not through euphoria, but through apathy. There is a reason this data isn't front-page news. A market that admits its primary pricing mechanism is under-collateralized invites scrutiny. It invites questions about settlement, force majeure, and rule changes. So the narrative stays focused on daily charts, macro noise, and unrelated headlines. Meanwhile, the inventory number keeps shrinking, one report at a time. The dead zone is not a single number. It's a range where confidence erodes, where participants realize that delivery is no longer a formality, where every new contract adds stress instead of liquidity. Once confidence cracks, behavior changes fast. And when behavior changes, price has to follow. Right now, silver is still being priced as if the paper market is functioning normally. That assumption is becoming harder to justify with every ounce that leaves registered status. The longer this divergence persists, the more violent the eventual reconciliation becomes. Markets hate imbalance. They don't resolve it politely. And the most unsettling part is this: the trigger doesn't need to be large. It doesn't require a surge in retail demand or a macro shock. All it takes is one participant deciding they want what the contract promises. In a market this thin, that decision echoes. Because once the first crack appears, everyone sees it at the same time. When delivery stress starts to build, the first place it shows up is not the headline price. It shows up in behavior. Contracts that are normally rolled without thought suddenly aren't. Shorts become aggressive about cash settlement. Longs quietly stand for delivery in sizes that don't make sense to anyone watching only the chart. This is exactly the pattern that begins to form when registered inventory slips into the dead zone, because the risk profile of the market changes underneath the surface. On paper, COMEX silver still looks liquid. Volume remains high. Open interest barely flinches. But liquidity is an illusion when it's all promises referencing the same shrinking pile of metal. When registered inventory is ample, that leverage doesn't matter. When it's near zero, leverage becomes a countdown clock. Every new contract is another claim on a base that is no longer expanding. The key mechanism most investors miss is how arbitrage normally keeps the system stable. When futures prices diverge from physical reality, metal is supposed to flow toward the exchange. High prices attract sellers, low prices attract buyers. That flow balances everything. But arbitrage only works when participants are willing to part with physical metal. Right now, they're not. And that's the break. Physical holders are signaling that silver is worth more to them off exchange than on it. You can see this in the way eligible inventory behaves. Eligible silver exists, but it's not being registered. That decision is deliberate. Owners are saying, I meet the specs, but I'm not making this metal deliverable. In previous cycles, that stance didn't last. Today, it's persistent. This persistence is what turns a tight market into a dangerous one. When eligible metal refuses to convert to registered, the exchange loses its pressure valve. Normally, stress pulls metal in. No, stress pushes it out. That inversion is rare, and when it happens, it forces price to do the work that inventory used to do. At the same time, the futures curve begins to behave in ways that don't match the narrative. Near-month contracts stop trading at the discount they should. Roll costs quietly rise. Lease rates creep higher, even if they're not widely reported. These are all signals that borrowing silver is becoming harder, not easier. And borrowing silver is how shorts survive in a physical squeeze. The global picture makes this even tighter. China's physical silver market has been absorbing supply at prices that don't align with U.S. futures. Premiums remain elevated even during price pullbacks. That tells you that real users are not price sensitive at these levels. They are availability sensitive. They care less about saving a few cents and more about securing metal. This creates a feedback loop that paper markets struggle to handle. Lower futures prices do not bring out sellers. They bring out buyers. Metal flows east. Vaults empty. Registered inventory shrinks further. And yet, the price mechanism continues to reflect paper selling pressure instead of physical scarcity. That divergence can persist for a while. It never persists forever. The last time silver faced a similar structural imbalance, the resolution was abrupt. Inventory levels didn't warn politely. They simply failed. Settlement rules were adjusted. Position limits were discussed. Volatility exploded. What makes this episode more severe is that the baseline is lower. There is less metal everywhere, not just on COMEX. Mining supply is not coming to the rescue. Silver production has been flat to declining, and much of it is byproduct production tied to base metals. When copper and zinc slow, silver supply follows. There is no dedicated silver mine capacity waiting to surge at current prices. Even if prices moved sharply higher, the response time would be measured in years, not months. That lag matters because industrial demand doesn't wait. Solar installations, electronics manufacturing, medical applications, and defense-related uses consume silver continuously. These sectors don't hedge on COMEX the way financial players do. They secure supply chains. And when they sense instability, they pull forward purchases. That behavior quietly tightens the market even more. From an analyst's point of view, the most telling signal is not what is happening, but what is not happening. There is no rush of metal back into registered inventories despite weeks of low prices. There is no surge in selling despite strong paper volume. The usual reflexes are missing. That absence is information. Another overlooked pressure point is the role of bullion banks. These institutions are both market makers and physical custodians. They facilitate liquidity as long as the system is balanced. When it's not, they reduce exposure, they widen spreads, they discourage delivery. None of this is announced. It simply shows up as friction. And friction in a leveraged market amplifies every move. As registered inventory approaches functional zero, the margin for error disappears. The exchange can still operate, but only under the assumption that most participants will behave as they always have. The problem is that behavior changes when confidence erodes. The moment a few players decide the risk of cash settlement outweighs the convenience of rolling, the dynamic shifts. This is where narratives become dangerous. When commentators say silver is weak because the price is down, they ignore the physical signals screaming underneath. Weak markets don't experience persistent inventory withdrawals. Weak markets don't show rising premiums during price declines. Weak markets don't see eligible metal refusing to become deliverable. The dead zone forces a binary outcome. Either metal flows back into registered inventories, restoring confidence, or price rises enough to ration demand and attract sellers. There is no third option. The longer the price stays disconnected, the sharper the eventual adjustment must be to rebalance the system. What makes timing this impossible is that the trigger is invisible until it happens. There is no countdown ticker, no warning bell, one delivery notice, one failed roll, one unexpected stand for metal. And suddenly the conversation changes everywhere at once. Right now, the market is pricing silver as if none of this matters, as if registered inventory is just another statistic, as if leverage has no consequences. That complacency is exactly what precedes disorderly moves. Because once participants realize the exchange is operating on trust instead of metal, trust becomes the most fragile asset of all. And when trust breaks, it doesn't leak out slowly, it vanishes. When trust disappears from a futures market, the transition is not subtle. It doesn't announce itself with press releases or official warnings. It shows up as hesitation, a pause where there used to be routine, a question where there used to be certainty. In silver, that moment always centers on delivery, not speculation, not sentiment, delivery. And with registered inventory sitting in the dead zone, that question is now unavoidable. The COMEX system only works if participants believe contracts can be honored as written. Most of the time, nobody actually tests that belief. They trade, roll, offset, and settle in cash. That's fine when metal is abundant. But when registered silver is effectively zero relative to open interest, belief becomes fragile. Every participant knows the math. They just assume everyone else will keep playing along. That assumption is what breaks first. The moment a few large players decide to stand for delivery simultaneously, the exchange faces a problem that cannot be solved quietly. Either metal appears or incentives change. Historically, exchanges respond by raising margins, adjusting rules, or encouraging cash settlement. Those actions calm the system temporarily, but they also confirm what insiders already know. Physical scarcity is real, and confirmation changes behavior faster than price ever could. Once the market internalizes that registered silver is no longer a reliable backstop, paper selling loses its power. Short sellers become cautious. Market makers widen spreads. Volatility increases, even if the price doesn't immediately explode. Liquidity dries up at the edges. This is how structural stress expresses itself before the headline move. What's critical to understand is that none of this requires a surge in demand. Demand is already there. Industrial consumption continues regardless of price. Investment demand ebbs and flows, but it doesn't need to spike for this to resolve violently. All that's required is a refusal to sell. And that refusal is already happening. Eligible inventory sitting idle is the clearest proof. Those ounces could earn fees. They could stabilize the market. They could ease pressure. Instead, they remain unavailable. That tells you the holders believe silver is mispriced relative to risk. They would rather forgo income than expose themselves to delivery obligations at current levels. From a monitoring standpoint, the next signals come quickly once this phase begins. Delivery notices start clustering, spreads between spot and physical widen further. Regional premiums detach completely from futures pricing. You see silver traded at one price on screens and another in the real world. That disconnect is not theoretical. It has happened before. In past cycles, the resolution often shocked those who believed the market was too controlled to fail. Price didn't drift higher gradually. It gapped. It overshot. It forced repricing not just of silver, but of risk assumptions tied to it. This is why professionals watch inventory more closely than charts during these periods. Another factor amplifying this setup is the broader macro environment. Confidence in paper, claims across asset classes, has been tested repeatedly. When trust erodes elsewhere, it doesn't leave commodities untouched. Silver, sitting at the intersection of money and industry, becomes a pressure release valve, not because of narratives, but because of necessity. For institutional players, silver's role is simple. It's one of the few markets where paper volume vastly exceeds physical backing. That leverage creates efficiency until it doesn't, and when it doesn't, the unwind is asymmetric. The downside is limited by physical scarcity. Upside is limited only by how fast the price must move to restore balance. That's why the dead zone matters so much. It's not a gimmick. It's not a slogan. It's the range where the market stops being self-correcting and starts requiring force, either force through price or force through rule changes. Both outcomes are disruptive. Retail investors are usually the last to notice this shift because the surface indicators remain calm. Silver can look boring right up until it isn't. Volume stays high. Analysts stay dismissive. Headlines stay quiet. Meanwhile, the plumbing is screaming. The most dangerous assumption right now is that because silver hasn't moved yet, it won't. That assumption ignores every historical precedent tied to inventory stress. When physical constraints resolve, they do so suddenly, because the market has delayed adjustment for too long. The final stage of this process is psychological. Once participants realize registered inventory is no longer a safety net, they stop treating contracts as interchangeable with metal. That distinction changes everything. Futures become riskier, physical becomes premium, and price has to bridge that gap in a hurry. At that point, the conversation flips. Instead of asking why silver isn't going up, people ask why it ever traded this low. Instead of dismissing inventory data, they scramble to understand it. Instead of rolling contracts casually, they seek exposure that can't be settled away. By then, the move is already underway. The COMEX registered silver number doesn't need to hit literal zero to trigger this. It only needs to stay low long enough for confidence to crack. And it has. Quietly, persistently, with no sign of reversal. That's why this moment matters. Not because of hype, not because of forecasts, but because the structure of the market is no longer aligned with the price it's advertising. When structure and price diverge, price always loses. And the longer that divergence is ignored, the more violent the correction becomes. Because in the end, silver doesn't need belief to function. It needs metal. And right now, the metal isn't there.